Hello everyone, welcome to Money Control's Ideas for Profit. Today we are going to discuss about the Q3 earnings review of Future Supply Chain Solutions. Well, the company has been delivering a strong set of numbers in Q1 and Q2, and Q3 was again a very strong quarter. In terms of the top line, the company did a top line growth of around more than 40% on a year-on-year basis. Even on a sequential basis, the top line was higher by 6 to 7%. The gross margins, however, a bit under pressure due to the increase in the fixed cost asset base. However, the EBITDA margins continued to remain stable on a year-on-year basis. Operating profits as well as net profits were again higher by more than 50%. Overall, it was a very strong performance for Future Supply Chain Solutions in the quarter gone by. Talking about the key highlights from the results. Well, the company operates in 4 major segments. The first is the contract logistics segment, which generates around 65 to 70% of the revenues of the company. This segment primarily deals with warehousing as well as distribution centers. So the addition of warehouses in the past 12 to 18 months has actually increased the asset base of the company, and the new client additions as well as increase in capacity utilization of the existing warehouses has resulted in a strong revenue growth of more than 60% on a year-on-year basis for this segment. Express logistics segment, which is the second segment of the company, which contributes around 15% of the overall revenues of the company, was again had a very strong quarter. The revenues were higher around 10 to 15%. 30 to 40%, aided by a volume growth of around 18% in the quarter gone by. The third and the fourth segments, the temperature control logistics as well as the last mile delivery solutions, the company, these two segments together contribute around 15% of the revenues from this segment were again higher by around 10%. Overall, it was a very strong performance from the company led by the contract logistics segment. But in terms of the margins, the gross margins were under pressure on a year-on-year basis because the capacity addition has led to the increase in fixed cost structure of the company. Therefore, the gross margins declined on a year-on-year basis. However, these were contained on an operation level, which continued to remain stable on an overall basis. The other factor which was a negative in the results was the increase in net debt of the company. The increase in asset base has been the primary reason for the increase in the net debt of the company. The warehouse addition from 4.5 million square feet in around Q2, Q3 last year to around Q3 to 7.4 million in the Q3 gone by has primarily resulted in the increase in the net debt of the company. The company has issued a non-convertible debentures of around 200 crores, and the cash at the end of the quarter remained at 120 crores on the quarter gone by. This is the primary reason the net debt of the company, the net debt to EBITDA of the company has increased to around 0.8 times in the quarter gone by. Well, the sector has been growing at a very steady pace. The introduction of reforms from the government side, specifically the GST as well as e-way bill, is aiding the demand for the sector. That said, along with that, the e-commerce segment has been another boom from the demand front. So overall, the sector is growing at a very fast rate. In terms of the specific pockets that are gaining more traction is the warehousing as well as the distribution centers. So that is, we see a lot of newer players entering into this arena and setting up existing capacities to be able to gain a more share of this segment. However, that being said across, the competitive intensity has also picked up. So a number of technology-backed players which are well funded by private equity are putting a pressure in terms of the pricing. So that is one factor that needs to be watched out for. Talking specifically about Future Supply Chain Solutions, the company has a strong revenue pipeline of around 4 to 500 crores that it plans to cater in the next 12 to 18 months. And they're also putting up capacities in terms of their they're also putting up capacities of 3 million square feet in the next 12 to 18 months to be able to cater to that demand. Overall, the business has a very consumer-centric focus in which the demand generally tends to be very sticky. In terms of the valuations, the company is trading at around 23 times FY20 earnings, so which appears fairly reasonable from a long-term perspective. Investors, therefore, with a long-term view can look forward to accumulate this stock on dips. Well, that's it about the Q3 earnings review of Future Supply Chain Solutions. For more views and updates, do log on to moneycontrol.com.